Chat. All right, Jenny Horn, host of Next Gen Investing here, and she's taking a look at some movers announcing earnings and big news, and Spotify is there. There were a lot of high hopes for Spotify, but right now this stock is down.
Yeah, and high hopes are perhaps the problem, because when you have your CEO saying that there's more noise to come and you miss on earnings, I think that high bar might have been a bit lofty. So we saw shares tumble as much as 7.5% this morning after the stock had surged about 34% this year. I also feel like this has been somewhat of a theme where these companies that have done so well in spite of all of this volatility have gotten kind of killed on earnings. We're seeing something similar right now with Brinker, which is another name that's outperformed. Totally different world, but I do think that's what happens when you are one of the leaders of your given space, which Spotify frankly has been. They tripled their operating income in the first quarter. Revenue rose about 15%. That figure did slightly miss. And we also did see subscriber growth was around 12% to around 268 million subscribers. That was actually better than expected, while monthly active users, which is huge, rose about 10% to around 678 million. That was completely in line with estimates. So they did say that their short term may bring some noise, but they do remain confident still in the long-term story. And the direction they're heading feels clearer than ever, were the words. So operating income, they did cite, was hurt by just shy of around 87 million of what they called social charges, which are payroll taxes that can often be associated with employee salaries and benefits. So expenses also go up as we see its share price rise, though. So it's sort of a paradox there. But their results were also flattened by a shift of the timing of their annual equity grants from the first quarter to the second quarter, and did say that monthly active user growth was still led by Latin America and the rest of the world, which actually excludes North America and Europe, while premium subscribers still rose about 12%, despite the fact that we did see some widespread price increases enacted here in North America, but now we've heard more wind of that now happening in other major nations for Spotify. So you'd think this would be the recipe for success, as they do have that pricing power similar to a Netflix. But unfortunately, I just think when you have outperformed this market right now, you have to be able to really, really enthuse, and that just wasn't really the tone we heard on the earnings call.
Yeah, understood. I mean, yesterday, Kenneth Leon over at CFRA talked about a buy rating. He talked about what a moat it has. Apple's not a competitor, the revenue growth, the global footprint, the potential for expansion. He had so much to say in a good way, and he had a price target of $675 for the long term. So still likes his name, big picture. How about UPS?
The UPS, very, very different story. Obviously here, actually rising after beating its expectations. And this is a great example of when the bar is set low. Seemingly, if you're able to just ever so slightly uptick that, you're given a positive outcome. So seeing a nice rise this morning after the company did say earnings beat expectations, which helped offset plans actually to cut around 20,000 jobs this year due to the loss of Amazon volume. They also said they will not be updating their full year outlook given the macroeconomic uncertainty. Previously had guided, though, for 2025 revenue of just shy of 90 billion. They did say they began this massive network configuration that will lead to consolidation of its workforce and facilities in anticipation of the loss of volume, of course, from Amazon. So right now, that will include those major job cuts, which is about 4% of their workforce if looking back at the last fiscal year. Additional buildings, though, may be closed as a result as they review right now their network for these inefficiencies. So due to these actions, they do expect to record between around 400 to 500 million in expenses, including some of these building closures as well as severance packages and various benefits. But the job cuts may also lead to what they said was this remeasurement of their pension plan obligations, but UPS could not yet determine that impact. So we did see net income rise. We also saw adjusted earnings per share increased on a year-over-year basis. Well, revenue actually still slipped modestly, about 0.7% to 21.5 billion, but did still at least beat what the street had been expecting. So again, I think that there's things to like, there's things to still have some pause about, but I know that this has oftentimes been read as the barometer of our economy. I don't really necessarily see that as true anymore in this evolving landscape, because there's so many ways you could read the consumer that is not just linked to some of these logistics and freight companies, as we've seen the underperformance of these companies for years now. I think the real threat here that is, I mean, maybe being overlooked by their efficiencies and some of their cost reductions is Amazon. I mean, Amazon is not going away anytime soon. And the bigger Amazon gets, seemingly, the more it steals that critical right now market share away from a UPS.
Yeah, and I mean, they saw some good news, to your point. I mean, they saw some strong domestic and growth international, but this outlook is killing everyone. And they are not the first company now to start to announce layoffs. We've heard now from several companies across different sectors announcing layoffs, 20,000 jobs. I mean, that's a good amount of jobs. And by the way, 6 months, UPS is down 30%, FedEx is down 20%. These stocks are not necessarily doing particularly well either.
No, and that's a great point, because I do feel like a lot of times you see this type of headline and everyone wants to link it to everything that's happening right now with tariffs and Trump. But also remember that FedEx underwent that massive company restructuring to right-size its costs and also had some pretty substantial layoffs. So I see this network configuration that they're calling it as something that's probably been months in the works and not necessarily I don't think it can necessarily be attributed to what is going on with the administration and right now the macro. Obviously, that plays a huge part, but I'm sure this has been now in the works for several months at this point, just given how massive these true business configurations can really be, especially because we've gotten similar narrative from FedEx already, which has actually been a bright spot for them. Right-sizing their costs has been huge, and I think it will be the same eventually for a name like UPS.
All right, Jenny Horn, great to see you. Great coverage of names reporting. We have 184 S&P 500 names this week, and of course, 4 of the Mag 7 names in focus. Jenny Horn, thank you.